This is the mini lecture for Unit 4 of Governmental Accounting and Auditing, this week focusing on accounting for governmental operating activities. This is when we're really going to start getting into the nitty-gritty of the accounting requirements, the ways that transactions are accounted for, particularly those that affect the inflows and outflows of resources, and understanding the differences between the two main bases of accounting and measurement focuses in governmental accounting. On the one hand, accrual accounting that is present in all of the financial statements except three. It's not in the governmental fund financial statements, and it's not in the cash flow financial statement for the proprietary funds. That latter one obviously being a cash basis of accounting and a cash measurement focus, just looking at cash flowing in and out. But accrual is your most comprehensive and really the polar opposite basis of accounting from cash. It includes the flows of all resources, which in governmental accounting referred to as economic resources. That's the measurement focus, what the what is being measured, what flows are being measured. So you're looking not just at cash in and out, but promises to pay that are given by the government and received by the government from others. The addition of capital assets through construction and purchase, as well as the depreciation of those capital assets over time. Those are all economic resources that in the sense that you're capturing all of the flows of resources in and out, regardless of whether they're cash or liquid or capital or whatever. Those two governmental fund financial statements then use modified accrual and a current financial resources measurement focus, which is focusing on the flows of current financial resources, mostly cash, short-term investments, short-term payables and receivables. But as you will see, it's not a conceptually pure basis of accounting, and so there are some things that are not current, for instance, like some long-term interfund receivables, and some things that are not financial, like inventory. So a measurement focus, as I touched upon, describes what types of elements you're accounting for, and the basis of accounting describes when the inflows and outflows of resources should be reported. In terms of the debits and credits that are in this chapter that you're going to want to focus on very closely, you're going to want to look at those associated with budgetary accounting, such as appropriations and estimated revenues. We saw in the last unit this budgetary equation that estimated revenues plus budgetary fund balance equals appropriations. You only see budgetary fund balance, of course, if the estimated revenues are not sufficient to match or exceed the appropriations. If they do exceed the appropriations, then you actually see budgetary fund balance on the other side, because the excess revenues would be increasing budgetary fund balance. In this case, there aren't enough revenues expected to cover the needed appropriations, and so the government needs to also use some of its existing fund balance to match those appropriations. And there is a note here that says that was incorrect in the Unit 3 mini lecture. What is really incorrect about it is that it depends upon the relationship between estimated revenues and appropriations. If estimated revenues are going to be greater than appropriations, then you're going to see budgetary fund balance on the appropriations side of the equation, because it's going to be, after the estimated revenues cover the appropriations, what is left over is going to be added to fund balance. And in this case here, estimated revenues are less than appropriations, so you need to use some of existing budgetary fund balance in order to bridge the gap between the estimated revenues and the expected spending in terms of the appropriations. Of course, if estimated revenues are projected to be exactly the same as appropriations, then there is no budgetary fund balance in this equation at all. You're also going to want to look at the debits and credits for encumbrance accounting. encumbrance accounting. One thing that is worth pointing out, it's a minor thing, but it's important, is that when you list your debits and credits for encumbrances, that you always identify them with the year. This is something that's important for expenditures as well, because there is some, sort of interperiod issues where, an encumbrance may be debited in one year, but it's not undone until the following year when the goods and services are actually received. And so marking them with the year helps you to keep track of what encumbrances it is that need to be reduced or credited at the time that you actually receive the goods or services, and then need to account for them appropriately. You're also going to want to look at the accounting issues related to property taxes in terms of, first and foremost, how you determine how big the tax levy needs to be. The tax levy is always going to be bigger than the revenue that is required, because very few governments manage to collect 100% of the property taxes that are owed to them, at least not initially. And so you need to make sure that that tax levy is big enough to provide all the revenue that the government needs during the year in order to cover its budgeted expenditures. That tax levy is based on a calculation of tax rates times the assessed value of property, and then adjusted to take into account that a certain percentage isn't going to be collected. The textbook lays out how that's done, and it may be the case this semester, as it often is, that one of the problems in the assignment involves figuring out how big a tax levy needs to be in order to produce a certain amount of property tax revenue. You're going to want to make sure you know the debits and credits related to recording the tax levy, to recording property tax receivables and revenue, as well as recording the uncollected portion, and the point at which you go from current property tax revenue to delinquent property tax revenue accounts. You're also going to want to make sure that you understand this notion of what a non-exchange transaction is. You're not going to have this nailed down in this unit, but this is the place where you're going to have to start to cope with it, because it's a pretty significant part of governmental accounting. When you're looking at private sector accounting, virtually everything you're looking at is an exchange transaction, a willing exchange of equal value between two or more willing parties. But a lot of governmental transactions don't involve willing parties, particularly tax transactions. The taxpayer generally is not willing, at least to say, if they had a choice, they probably wouldn't pay the taxes, but they don't have a choice. There's also no clear connection in a lot of cases between the payment that you're making as the taxpayer to the government, in terms of when you pay it and how much you pay, and the services that you receive in return, when you get them and how much you get. And so these are called non-exchange transactions, and because it isn't as evident as it is in an exchange transaction when revenue is earned, for instance, there need to be some specific standards in the governmental accounting standards to help governments understand when they're supposed to recognize assets, liabilities, revenues and expenses or expenditures, as well as deferred inflows and outflows. Other things that you need to know: you want to make sure you understand the debits and credits involved in closing entries at the end of the year. Take a look at the provisions for inventory accounting. Under full accrual, all inventory is accounted for using the consumption method, which means that you're putting an expense on inventory that's related to the amount of inventory that was actually consumed during the year. But under governmental fund accounting, where they use modified accrual, you can either use the consumption method or you can use what is called the expenditure method, which is that rather than calculating how much was consumed during the year and fixing a number on that for expenditures, a government would simply report an expenditure for inventory when the inventory is purchased, and it will never actually report the inventory as an asset. You also want to look at the debits and credits for revenues other than property taxes, including intergovernmental grants, income taxes, sales taxes, and so on. One of the things really important to remember, is that distinguishing between accrual and modified accrual is not as simple as pointing out the fact that under modified accrual, a government doesn't report capital assets or long-term debt. Too many people, I think, are quick to jump to the conclusion that that means that capital asset transactions and long-term debt transactions have no impact on the governmental funds, and that's not true, because they both may involve the flows of current financial resources. And if current financial resources are flowing in and out of the government, then they're going to be accounted for in the governmental funds, presuming that they're related to governmental activities. So you just want to remember that when you're doing the journal entries for the homework assignments, that for capital asset related transactions, for long-term borrowing transactions, that there are likely to be debits and credits, not just for the accrual-based financial statements, but for the modified accrual financial statements as well.